Futures down on concerns about the economy and the geopolitical situation. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, Google's biggest deal ever. The tech giant buys cloud security firm Wiz for $32 billion in an all-cash deal. And peak U.S. exceptionalism? Bank America's latest survey shows investors slashed exposure to U.S. equities by the most on record in recent weeks. Meanwhile, on the geopolitical front, investors are watching what emerges from President Trump's call this morning with Russian leader Vladimir Putin, and we've got a re-invasion of Gaza. Let's take a look at where markets are trading this morning. You can see futures down, and they're moving further down. We were positive around 4 a.m., but have been deteriorating ever since. Off 0.5%. NASDAQ futures off 0.7%, and we're very focused on what's going on today in the tech sector. You can see the 10-year yield still holding right there at 431.60, so no change from that 430 level that Sonali's been watching. Some of the stocks that I'm keeping an eye on this morning are, well, they're all tech stocks. Investors hoping to get answers about the direction Nvidia is headed as competitors catch up to its dominance in AI. That's the concern, right? CEO Jensen Huang is going to try and convince you otherwise when he speaks at 1 p.m. Eastern. We'll bring you all the breaking news from that. Sonali?
Yeah, very much excited to see what he says. Excited to break this down throughout the course of the show with you. Also excited to break down exactly what's happening here. Alphabet shares. This is the parent of Google. They're spending, as we've been talking about, $32 billion in cash to take over cloud security company Wiz. This has been a dramatic story for the past year. Alphabet shares, though, now down about 0.3% pre-market. There's some doubt that's baked in here, uncertainty. And speaking of uncertainty, there's also uncertainty around growth, and that's continuing to weigh on market sentiment. Here is what we've heard from some of the top guests on Bloomberg into the trade.
Unless the Fed does something tomorrow, which they might, but I don't think they will, when we see a real change in messaging, I think we resume the sell-off, and I think we're going to head to bear market territory down at least 20%.
As long as the economy grows at 1%, credit markets are dancing and singing, having a great time. Meanwhile, equity markets are suffering, and they're not going to show a lot of appreciation, going to show a lot of volatility through this transition period. So I think credit is the place to be. It's the golden era of credit.
There is a fundamental rethinking of everything in relation to investing in the U.S. or being exposed to U.S. Just because the U.S. today is a fundamental different environment than the U.S. 1 year ago.
It's been a perfect mix for taking capital outside of the U.S.
All right, great to hear from Bruce Richards there on credit, but we're so focused on equities ahead of the open this morning, Sonali, and the Bank America survey I found pretty shocking, right? You found U.S. exposure, they found U.S. exposure dropped 40 points to 23% underweight. Obviously, everyone's getting overweight European stocks, but it's the cash levels that surprised me the most. They've risen to 4.1% from 3.5%. That's the biggest jump since 2020.
Cash is king still, and you also have to wonder whether people are just waiting to know what that bottom is. We've been talking about it. It is ephemeral. No one knows exactly what that moment is to deploy that cash. Another note that Yardeni put out, Ed Yardeni, I've been watching him very closely because he's pointing out now that foreign investors, not just U.S. investors that have obviously been burned, foreign investors start to pull out of the U.S., particularly because of their overweight exposure to certain stocks, Tesla, Nvidia.
Yeah, huge underweight on those stocks. There are a lot of shorts we're going to talk about later on the Wall Street beat, what hedge funds are doing, how they're making money. One of the few places that they're making money is shorting Tesla. Let's get back to the Google story, though. $32 billion in cash to buy the cloud security company Wiz. This is their second go-round, at least. Bloomberg Intelligence senior analyst Mandeep Singh is here. And Mandeep, we were talking to you about this last year when it was a $23 billion offer and Wiz walked away. What's changed? Is it just $9 billion more?
Yeah, and also when you look at it from a Google standpoint, they, I think, need to diversify all the more given the pressure on the consumer side. And look, there is a pending DOJ case against breaking up Chrome. So there is a lot going on in terms of their consumer side of the business. Cloud is what's worked for them. If you look at, the whole AI wave, it's added almost, 10 percentage points of growth to their cloud business, which is a $50 billion run rate business. And security could be additional when it comes to, the enterprise side that Google has, which is much smaller compared to a Microsoft.
Truly, one of the biggest concerns in the market is, does this get past antitrust? I think this administration has come down harder. People look at HP, for an example, to see how things have gone. There's that report overnight. We'll talk about it. Capital One Discover as well. A little bit of concern there. Does Google have a clear path here?
I don't think there is any clear path here. But at the same time, when you look at Google as an overall entity, consumer side is still more than 80% of the business. And so from that perspective, cloud is still, 12 to 13% of total revenue. And I could argue they have very low exposure in security. So they're not stifling the competition. There are a number of pure play players. And the antitrust argument is weak, but you never know. Like you said, with HP, Juniper, we saw that, and there's always a concern when it comes to the antitrust.
Well, we heard from Andrew Ferguson yesterday, right? The new FTC boss. I think you talked to Caroline Hyde on Bloomberg Technology, and he was saying they want to get out of the way. Unless there are, rules being broken, unless there are laws they need to enforce, they want to get out of the way. So I'm sure you saw that.
Could be other regulators, too. So it's not just U.S. regulators. This deal needs to be approved by EU. I don't know if it needs China approval, but there are other regulators that could stop the deal as well.
Yeah, we'll talk more about deals in just a moment. I want to shift gears. I want to talk about Nvidia. Another big moment for Jensen Huang. Of course, a lot of negativity around this stock into this year. Can he shake off investor concerns around tariffs? How exactly do tariffs start to eat into Nvidia's performance?
Absolutely. And look, even this Google deal, I would say, Google is one of their 4 top customers that contribute to 45% of their revenue. If Google is spending more cash, $32 billion in cash on buying a company, what does it do to their CapEx going forward? Because in the end, it's that same bucket which is being allocated to CapEx and M&A. So to my mind, all the hyperscalers are getting more prudent when it comes to, the CapEx plus OpEx and how it ties to revenue generation. And it's no more upfront spending on, building infrastructure, at least to the extent we have seen in the last 12 months. So that in itself is a sort of a bearish argument that you're not going to see the sort of lifts we have seen from these hyperscalers around the CapEx side in the last 12 months.
You ask him about his previous research, because I know you were reading back through Mandeep's old stuff.
I was, and you made this amazing point about how if SailPoint went through and was able to successfully IPO, then it would set the stage for Wiz. And the reality of it, yes, they made it to market, but it's been a really choppy trade in SailPoint. They actually were down the day they IPO'd. Was there a path? And frankly, Wiz is a giant in the room here. Was there really a path for other companies like this to IPO? I actually think this deal in some ways is pretty negative for companies that are not Wiz.
Well, so look at the growth of this company.
What was Palo Alto?
Yeah. So, Wiz, I guess, allure here is they are doubling their revenue from, $500 million to $1 billion AR. There are no other security companies like that, so that's why Google seems to be paying up. But SailPoint, when they went public, it was a pretty high multiple. So you really have to look at the multiple with respect to the growth prospects. And in this case, it looks like Google feels this is a company that is the fastest growing cybersecurity company out there. And that's why they're paying up to buy this asset.
Mandeep, we are so grateful to have your analysis here. That is Mandeep Singh of Bloomberg Intelligence. And of course, what a day. We have this deal. We have Nvidia. I want to pull up something for you, Matt. I want to blow your mind a little bit here.
Okay, I'm ready.
I want to pull up exactly what's been happening in another deal, Capital One Discover, because when Trump won the election, you saw Capital One and Discover just soar on the heels of that news. And if you look at a one-year chart, you can see that they've erased almost all their gains. They're both up about 2% since the election still. Just look at that Trump bump that they had. Yeah. Now, with more doubt over this deal, that investor optimism has been pulled out. Remember, merger arb, event-driven funds, they have been a hot trade in this market. Anastasia Amoroso is an interesting interesting person that has been suggesting event-driven would be one of the hottest strategies of the year, for example. But we're not seeing it. There's a lot of doubt out there. Let's see if Google gets done.
We need to cut some sound from that Andrew Ferguson interview, and we'll bring you that sound as soon as we do, because I think it's fascinating that he wants to get out of the way, he says, but as Mandeep points out, there are other regulators outside of the U.S. as well. Of course, we are watching very closely. Futures here down right now. You can see S&P futures off 0.4%. NASDAQ futures down 0.6%. This is something that could turn around. At 1 p.m., don't forget, we hear from Jensen Huang, the CEO of Nvidia. He's pulled rabbits out of hats in the past, and he could do it again today at Nvidia's GTC, the GPU tech conference that they have. So we're going to be watching closely shares of Nvidia, but also shares of a lot of electric car makers that, Nvidia has made partnerships with, could announce new partnerships with. We're going to be watching shares of all of their competitors, which tend to move. You'll watch the Sachs index, I'm sure.
Yeah, absolutely. And I'm just fascinated. You and I have been watching. We walked in yesterday. Nvidia, there was optimism around this moment for Jensen Huang, but then you saw the trade really turn around. You saw Nvidia down about 1% yesterday. It's down another 1% pre-market today. Yep. Tesla also, which Morgan Stanley expected to maybe benefit from what Nvidia had to say, down another 4% today. Can Jensen Huang bring positivity into this market, let alone
maybe
his
not
stock?
for Tesla, right? I mean, it's so interesting that these two stocks are so connected because Tesla's a car maker, right? NVIDIA makes artificial intelligence chips, but obviously Tesla wants to pivot. Their valuation is far higher than any other car maker in the world. So investors expect AI. They expect apparently humanoid robots out of Tesla.
Which I'm most excited about.
And they're going to need chips for that. So we're watching NVIDIA very closely today and everything around it as well. 20 minutes until the opening bell. Less than that, Victoria Fernandez of Crossmark Global joins us here in the studio. We got her out of Texas. And Vladimir Putin wants Trump to stop sending arms to Ukraine. More on those ceasefire talks and the assets they'll be divvying up next. This is Open Interest. Getting out of high interest, look at what's making headlines around the world. The stock market's recent chaotic run is unleashing a windfall for equities traders on Wall Street. JP Morgan is on track to boost revenue from equities trading by more than 30% this quarter from a year earlier. If that trend keeps up, the bank could blow past its record of $3.3 billion set 4 years ago. German lawmakers are debating a plan to release defense spending from debt restrictions and set up a 500 billion euro fund for infrastructure investment. Germany's chancellor-in-waiting Friedrich Merz called the package a first great step towards the broad European defense community. German bunds have risen since reports of a potential fiscal boost to the German economy that began in the wake of last month's election. We're expecting an outcome, by the way, of that vote shortly, and we're going to be following it for you. You can see German bunds falling today and yields up. Bloomberg has learned that Russian President Vladimir Putin is demanding a suspension of all weapons deliveries to Ukraine during any ceasefire proposed by President Trump. The two leaders are set to speak by phone sometime in the next 2 hours about ending the war in Ukraine, at least temporarily. A key objective of those talks is the 30-day truce that Kiev has already said it's ready to accept. Sonali?
And Matt, we're going to look at some of the stocks impacted by that Ukraine news. Of course, a lot of geopolitical uncertainty. So we're going to take a look at Lockheed Martin, RTX, Northrop, General Dynamics. It's interesting to see the disparity in the trade as well. Remember, some of this is valuation. Lockheed has been inching higher throughout the year, but still down on the year. RTX, though, up 14% this year. This has been somewhat of a darling when people have been looking at the defense stocks. So a lot of uncertainty, like I've been saying. But the thing about this is these geopolitical conflicts are now being fought on a different stage. People are looking more and more to companies like Palantir and other types of heavy tech companies as well when they think about defense.
Yeah, and especially European companies, right? Because when you expected the U.S. to be funding all of this, they were obviously spending money here at home. Now that it looks like Germany may unlock 500 billion euros in spending, and that its EU counterparts may also start to spend hundreds of billions of dollars more on defense. They're likely to do it on the continent. So you see Rheinmetall up right now 2.75%. ThyssenKrupp right now up almost 10% on the day this is. Leonardo up more than 1%. BAE Systems down. But these stocks have been soaring, outperforming any other group in Europe year to date, outperforming the S&P. And I see a smirk.
No, well, yes, because I'm taking a page out of your playbook. I'm looking at the price to earnings ratio. Rheinmetall was up to 65 price to earnings right now as a ratio. You have actually RTX trading at less than that. So I think that that's really fascinating to show you just how investors feel about the European defense trade versus the U.S. one.
Yeah, it's a huge. By the way, if you check out CHRT, and this week it's going to work. So if you're sitting at home in front of your Bloomberg or perhaps at the office and type CHRT Go, you're going to find a wealth of charts in the Bloomberg terminal. There are some great ones on the defense sector as well. Here's a great overview. You can filter through these, which I love because it's so searchable, and you can just see the incredible outperformance of European defense stocks. Let's take a look at the broader indexes ahead of the open. We have 12 minutes to go, and you can see that S&P futures are still down. Futures are down really across the board. We had industrial production out a few minutes ago, and we saw that it was up 0.7% month over month. That's better than the estimate, which was for 0.2%. And this is one of those numbers that President Trump wants to see go higher and higher. Nonetheless, it's having little effect on stocks today. And I thought it was interesting in the Bank of America note, Michael Hartnett said, in order for the S&P to get back to 6,000, you need to have kind of a ceasefire in the trade war, and you need to have inflation expectations come back down. They've been ramped up, obviously, in the University of Michigan survey, and the trade war, it's on full blast.
Full blast.
Until April 2nd.
Yeah, it makes April 2nd a big day to watch. Also, just to point out what you've been trying to say for the last couple of days, Tesla, MicroStrategy, these are some of the biggest moves on the downside pre-market, which is going to signal some pain no matter what for the NASDAQ 100 in the open. We have been turning lower, and those are some of the stocks that are weighing on it right now. Yeah,
of course, Nvidia could turn all that around, and we're looking forward to Jensen Huang's speech at 1 o'clock. Coming up, we have 10 minutes to go until the markets open. We're going to talk with Crossmark Chief Market Strategist Victoria Fernandez about what she thinks. Is this a buying opportunity, or do you need to hold tight until you see the whites of their eyes? This is Open Interest. All right, this is Bloomberg Open Interest. Let's take a look at what's going on with futures ahead of the opening bell. You can see that they're down across the board. Even after that better than expected industrial production number that we got out, there are real concerns about the geopolitical situation as Israel reinvades Gaza, as Vladimir Putin asks Donald Trump to stop sending weapons to Ukraine, and also really concerned about tech stocks in general. Sonali pointed out, tech stocks down across the board, and ahead of this Jensen Huang speech, I guess if you're a courageous dip buyer, this would be the time to buy.
We're going to find where those dip buyers are because, to your point, geopolitical overhangs really weighing on the market at the moment. A lot of scary headlines that are on the top of read right now on your terminals, but also, can Jensen Huang save the day? We're going to find out the answers to those questions. We're going to bring in now Crossmark Global Investment Chief Market Strategist Victoria Fernandez. And it's kind of hard to think that tech could save the day in this particular market. I mean, Jensen Huang, of course, is a massive moment in this market. But at the same time, there are a lot of fears that are kind of overhanging the ability for people to buy this dip. What is your biggest concern at the moment?
Yeah, so I think we're looking at the consumer and their concerns around growth and how that's going to really lead to some stalling in this economy. And so that's my concern, because I think that feeds on itself and starts flowing through. Obviously, tech had been the savior for quite a while, and that's come back, and we're looking for that breadth in the market. Friday was a good start, 9-1 on advances versus decliners. Yesterday was not quite as good, plus 5-1. But we really need to see some strength coming. And I think until the consumer feels better and until we get out of the uncertainty around tariffs, we're not going to see that.
I had actually written down 3 bullet points that Sonali liked earlier, so I'll go through them again. On the consumer, 12-month checking and savings balances declined across all income levels. That's over the last 12 months, back to 2019 levels. Wage growth slowed for all income groups over the past year. That's according to data from the Atlanta Fed. Americans' inflation-adjusted debt is rising past pre-pandemic levels. Right. So even though we have unemployment at 4.1% right now, the consumer does not look strong at all.
No, there's a lot of weakness there, and I think the key word, Matt, that you said there was all. It's all income groups that we're seeing this. For the longest time, we saw struggles for low and middle income consumers. High income consumers were really kind of driving everything and supporting the economy because they were still spending. Now we're seeing the issues across the board. You're seeing underemployment, which I actually think is more important than the regular employment number. That underemployment number is reaching new highs. You're looking at employment to population ratios coming down. Hiring is coming down. And the jobs that we are getting, they're those non-cyclical jobs, right? It's healthcare, it's education. It's not those other jobs that you like to see to say there's a strong economy. And you get into kind of a negative feedback loop. As the consumer starts to worry about their job, they pull back spending. As they pull back spending, revenues come down for corporations. They have to look at their margins. They have to cut jobs, and you just start to see that cycle intensify.
Less than 4 weeks from earnings season.
Yeah, absolutely. And the wealth effect's not having a great impact either on the consumer. I mean, if you're looking at your 401k as often as I do, you're not in a good place right now.
It's a brutal thing because you're not supposed to look at your 401k, but you know, if you're my mother, for example, and you're retiring, it really doesn't feel good.
I'm her age. That's why I look so much.
You are not her age. You got a while.
I'm sure she's a very young and healthy woman. Victoria, you're going to stick with us through the open. Great to have Victoria Fernandez here from Crossmark. We are looking at futures that are down big into the open. Not huge, right? But 0.5% losses into the open after 2 days of gains. Maybe that's to be expected. We have less than 4 minutes to go until the opening bell. This is Bloomberg TV. This is Open Interest. We are moments away from the start of cash trading on Wall Street. This is Bloomberg Open Interest. I'm Matt Miller. You see futures continue to be down across the board on concern about the geopolitical situation, Israel reinvading Gaza, Ukraine making demands from President Trump that a lot of people are worried he's going to give in to. You can see the Russell 2000 futures off 0.5%. NASDAQ, though, doing the worst, down 0.7% as the tech stocks really continue to weigh on these markets. Take a look at first of all, the bell ringers. Amex, I was looking at the stock, right? And it's been decimated year to date. It's down 11%. But if you look over a 5-year period, it's up almost 4 times, right? More than double the gains of Visa and MasterCard. I think 285% is the gain. Down on the NASDAQ market site, you have Analog Devices ringing the bell. They've done incredibly well as well over the last 5 years, up, I think, 170%. So a couple of winners ringing the bell. Maybe that bodes well for the day. Let's take a look at the major averages as we settle in. We're still going to see red arrows here across the board, about 0.5% on the S&P 500, more on the NASDAQ, almost double that, and the Russell 2000, these small caps not getting any love either. But this could really turn around in about 3 hours' time. Nvidia's CEO Jensen Huang is going to speak at 1 o'clock at his own chip conference. It's going on all week long. Investors are hoping to learn more about his vision to expand his AI reach into real-world applications, new products that they have, new partnerships that they have. So watch across sectors. Car makers may get a lift. Tesla, obviously a maker of humanoid robots, a lot of people hope could get a lift. But also watch the other chip makers. And then the hyperscalers. Sonali, you're watching one of those very closely.
Yeah, very, very, very closely. A lot of implications here. But to your point, a lot of negative sentiment in the market right now. Things could always turn around. There's been a lot of intraday volatility. But on the heels of a large deal, a $32 billion deal with Alphabet, Google spending $32 billion in cash to take over cloud security company Wiz. It is the largest deal to date for Alphabet, but you are seeing some negativity, about 0.6% move downward in the stock. Let's get all those details. We'll talk about it more later in the show. But, you know, some good news here, Matt, is that at least some large-scale M&A is coming back.
Yeah, absolutely. The question is, are regulators going to be okay with that? We heard a little bit out of the U.S. yesterday, but as Mandeep Singh pointed out earlier from Bloomberg Intelligence, there are other regulators to worry about. We're back here on set with Crossmark Global Investments Chief Market Strategist Victoria Fernandez. And Victoria, before we get to, you know, what could happen in tech, we're watching what is happening right now. Stocks falling. It looks like on geopolitical concerns. As Sonali pointed out, if you type READ GO on the Bloomberg terminal, you get the most read stories from our clients. And they're reading about Gaza. They're reading about Ukraine. They're not as focused on Google taking over Wiz.
No, it's all these geopolitical events that they are concerned about and how that's going to feed through to oil prices. I mean, oil has been one of the things that has been coming down that's been allowing possibly to see inflation relax a little bit. And now
but up
that
3 days in a row now.
Yes, and because of these geopolitical events, right, that we've seen coming. And so I think there's some concern around what that means for the energy sector, what that means for inflation, and what that means in general. I mean, there was a lot of positive elements for the economy based on the fact that we would see some ceasefires and some of this come to an end, and now we're getting the opposite story.
Yeah, people were ready for stability. They were ready for peace, both geopolitically and on the trade front. You know, I know this is about stocks at the open, but two things that I'm looking at in addition to oil, well, oil, for example, and then also gold, just to show you how negative things are. People are moving out of stocks. Where are they going to?
Well, we've actually seen, interestingly enough, a lot of flows into inverse ETFs, which tells you you are seeing that elevated sense of nervousness going out there, right? You're seeing an inverted VIX curve and then the inverse ETFs doing well. That tells me there's a lot of concern. There's a lot of nervousness. Gold has been doing really well, so maybe you see some things going in there. And we've seen yields pretty stabilized here, you know, as of late, right around that 430 level, between 420 and 430 on the U.S. 10-year. I think you have some funds flowing into fixed income as well to be a little bit of a buffer to the volatility we're seeing in equities.
I'll just point out to my mother, who often watches, that an inverse ETF allows you to bet against a stock.
Yes.
So it's essentially like shorting a stock, and the dangers there are high, right? Because your losses are unlimited as opposed to going along a stock. You know what? I spoke too soon about investors not being so concerned about Google. Sonali, look, if you filter out to 1 hour, it's the second most read story. As I was talking about earlier, we spoke with Andrew Ferguson, who took over the FTC. Actually, Caroline Hyde spoke with him yesterday. Listen to what he had to say about deals.
I think it's important to bear in mind monopoly suppresses innovation. Monopoly makes it very difficult for little companies with the next great idea to sort of rise. And I think it's very important if we want to sort of preserve the American innovating spirit that we create conditions in our economy that allow little tech who have the next great ideas, the next life-changing ideas for all Americans to thrive.
So he's saying basically that they don't want to stifle innovation and that they don't want to get in the way of things too much, right? But this is sort of the four pillars of Trump's election, right? He was going to deport people en masse. He was going to put up tariffs, and he's kind of acted on those two things.
Right.
He was going to cut taxes. We haven't seen that yet. And he was going to reduce regulation. Is Andrew Ferguson reducing regulation? Is this one of the good things?
I don't think we're seeing it to the extent that people were hoping. You know, we had all those animal spirits coming in after the election, hoping that regulatory policy would be a huge boost to GDP and to growth here in the country. And I think they're not seeing it to the extent they thought. It was going to be a complete 180 and everything was going to get approved. And we're just not seeing that yet. And when you look at the IPO schedule that's coming too, you don't see a lot of things happening there. We thought we'd see a lot more going there as well, and you're just not. So I think there's a little bit of a pullback from what people expected. It doesn't surprise me based on the fact that we have concerns around growth. We have the geopolitical concerns that we talked about. And it makes sense as CEOs of corporations talk about, we don't know what the plan is. We have to pull back on CapEx spending. We have to pull back on some of the other elements we thought we would be doing now. It makes sense that M&A and IPOs those would pull back as well.
Yeah, the pullback has been astounding. And I want to point out also that the stocks of Goldman Sachs and JP Morgan, which just soared after the election, they're now down on the year. A lot of people piled into this banks trade, and the behemoths of the industry are down.
Are they even off today? I thought that trading story was so good. Okay, they're up a little today, right? Because
we reported here at Bloomberg that trading revenue will jump meaningfully, about 30% over at JP Morgan. But one thing I wonder is, does that offset the weakness? You haven't seen as much M&A. You have Morgan Stanley's co-president warning today that deals are on pause. And also to the point on the consumer here, if the consumer is weak, can that save Wall Street, right? Can the banks trade work if consumers can't borrow?
Well, I do think banks are probably one of your better places to actually put your money to work right now, because financials are still in an uptrend. Even though they've pulled back and they've consolidated, they're one of the only sectors that are still in an uptrend right now. So there is some optimism in regards to that. Loan growth, hopefully, if we see yields come down, which is what President Trump has said is his goal, then you should see housing start to build. You should see credit and loans start to build again. We'll see if that comes to fruition.
All right, well, they're up today in a down market, right?
Yeah, that's true. A little bit of a place to hide, because volatility, unless it's gapping volatility, which means people stop in their tracks here. As you know, I'm so bad at idioms. I don't even know why I try anymore.
You're right. It's a gap. That's correct.
It's a gap volatility. Anyways, they're up today. It's a place to hide. Crossmark's Victoria Fernandez, we thank you so very much for your time. We're looking at a couple more movers on our radar, because two beloved stocks of last year are noticeably down today. Tesla, of course, has been noticeably down all year long, but now you're looking at another drop of 5.8% this morning. Palantir, I'm fascinated. This was one of your best performers last year, having a choppy trade this year, now down another 5% today. Remember, Palantir should have been a government beneficiary, right?
Yeah.
The
well,
Peter
still
Thiel
could
effect.
be. Still could be. I mean, Elon Musk has work to do yet, right? But it is, to me, surprising to see, Tesla's lost half of its value.
Yeah.
This was a $1.5 trillion stock, and now it's worth 700 and change. That's still a lot, right?
Yeah.
That's still more than like almost every other publicly traded automaker in the world combined.
And speaking of, I think we're going to talk more about those automakers next.
Yes, we are. We're going to talk about, well, throughout the program, we have some auto coverage for you. So coming up next, the fast lane to the future. Chinese automaker BYD unveils a lineup of electric cars that it says can charge almost as fast as it takes you to fill up a gas car. And then later on, we're going to talk about some pretty awesome gas cars. This is Bloomberg.
And it's time now for our top call, some of the analyst action from this morning. First up, we're looking at Pepsi getting downgraded. It is no longer a buy at Barclays. The analyst cites pressure on its snacking businesses and flags weaknesses in its Frito-Lay business. Pepsi down 1% after announcing a big deal just yesterday. Now, next up, Ralph Lauren is getting upgraded to a buy at Goldman Sachs. The analyst there cites the retailer's brand momentum. Ralph Lauren marginally on the rise, 0.3% higher. Finally, we're looking at Lucid because it's no longer a sell at Morgan Stanley, and it's getting upgraded to a neutral on its AI potential, and that potential is driving its stock higher more than 11% this morning, Matt.
Let's get more on Lucid and all things EV. We're joined for that by Bloomberg's Detroit Bureau Chief, David Welch. And David, I think, it's the BYD news that's the most exciting here, that they have technology that allows you to get 300 miles of range in a 5-minute charge. How realistic is that news? And, when can we see that coming to products on these great shores?
I think that'll be a while, but look, I think the technology is very realistic. One thing BYD and the Chinese EV makers have been able to do is they've really pushed the envelope here with infotainment and sort of HMI, customer interaction kind of technologies. They refresh, upgrade their models a lot faster than the rest of the world's automakers do, and they do have really good charging times when it comes to their EVs. So, look, I think the technology is legit. The question is, can grids handle them, first of all? So they're setting up their own chargers in China to be able to handle these fast charging vehicles. And there are heat and other things. There are some engineering issues with it that kind of require special investment around those vehicles, particularly with the grid and the charging stations themselves. But I think it's real. So to get to your question, how soon are they going to be here? Well, right now we've got heavy tariffs on goods from China. I don't think this administration wants to see Chinese cars coming in anytime soon and challenging all the companies that are here. So that's going to take some time. And then whether or not that technology would work on our grid with our charging system in the U.S. But look, these things often don't take that long, but I still think it would be years before you saw the 5-minute charging BYD for sale in the United States.
Yeah, for sure. So how are EVs doing here in the U.S., David? I mean, we see a lot of really negative news. Tesla's market cap is down by more than half in the last 3 or 4 months. But are we seeing negative sales growth, or is it just decelerating?
It's just decelerating. Now, it's decelerated quite a bit. You go back and look at 2023, EV sales were up 50%. Last year in the U.S., they were up 7%. There was a strong fourth quarter. I think some people maybe thought that the credits were going to go away, the IRA tax credits, as soon as Trump got in office. And I've heard from dealers just anecdotally that the growth has slowed down in January and February, but you're still seeing EV sales growth. We'll know when the quarter's numbers come out at the end of March, early April, but it's still growing. It's just we're kind of at the flat part of that S curve where you have to get beyond early adopters and tech geeks and luxury buyers and get into the mass market, which is tougher to do because the vehicles are still relatively expensive. But you're seeing more offerings out there from Hyundai, Kia, and General Motors especially, and some of those are pretty affordable EVs. So I think you'll see maybe a little bit of acceleration in growth as some of those vehicles start to hit dealerships in bigger numbers.
Yeah, David, how much of a problem is this for U.S. dealers here and car makers? Because you have BYD jumping so much that its market value surpassed over the last 24 hours Ford, General Motors, and Volkswagen combined. Pretty stunning. And then we have another story out on the terminal that is very much worth a read. This idea that cheap Chinese cars are tempting global buyers, and it's threatening the giants of the auto industry. Does the lack of a proper EV strategy in the United States pose a more existential problem?
We have two different things here. One, Chinese vehicles do have a cost advantage. That cost advantage is not easily transferred to the North American market because there are things like subsidized steel and aluminum in China and subsidies for factories and other things that help them drive costs down. Also, safety standards are lower. You can't drive those vehicles that they sell in China in the U.S. market. A friend of mine recently bought a BYD EV in Mexico, and it was $29,000. It's the size of a Chevy Bolt, actually a little bit smaller, and the range is like 220, 240 miles, I think. So, look, that's he loves the car, but that's not like some 500-mile range big SUV. That's a subcompact EV for almost $30,000 in Mexico. So that gives you an idea that they're not going to be able to just dump super cheap EVs here. But look, they're taking market share in Europe. They're taking market share in South America, which is a bastion for General Motors and some of the European car companies. China wants to become a net exporter of vehicles, and they want to take over the world vehicle market. And the only thing that's slowed them in Europe are tariffs, and the only thing that is stopping it from coming to the United States is tariff and protectionist measures.
Tesla was supposed to be kind of the savior of this industry in a lot of ways when it came to EVs and the lead that they had compared to some of the smaller upstarts in the U.S.
They did invent the industry.
They sure did. But one thing for the inventor here that was a painful trade for so long was trying to go short Tesla. Here we stand in early 2025, and Tesla shorts over the last 3 months, according to S3 data, made $16 billion in 3 months, and people are getting more comfortable to go short. Is that dangerous, or do you think that at this point, it's a trade that people are starting to get comfortable making?
I think people are comfortable making the trade, and also a lot of investors are just shying away from the stock period because where's the growth going to come from? It's uncertain when the Model 2 or the small affordable Tesla EV is coming, and really the big thing that drove the rise in the stock price before it fell recently was AI and autonomy. And look, that's just something that it's always tough to bet against Elon Musk and Tesla when it comes to the technologies they want to develop. They're often late, but they usually get there. problem is with self-driving vehicles, it's just such a difficult thing. They haven't tested the vehicles on public roads, with other motorists, pedestrians, people's dogs, fire engines, all that stuff, the way General Motors, now defunct Cruise, did, the way Waymo does. And I think Waymo's probably the best one in the U.S. at this. And they've been at this for 15 plus years, and they're still kind of taking a very cautious, slow approach to deploying these vehicles all over the place. So if Tesla's going to rush into this, I think for investors, there's a long prove-it period that technology is not only going to work, but that Tesla can monetize it, and it's going to deliver what Elon said it did.
Humanoid robots is what we're waiting for here on Open Interest. David, thanks so much for joining us. Bloomberg's David Welch, our Detroit bureau chief. In the next hour, we're going to talk about, well, kind of vintage Mustangs. At least that's what they look like, but they have carbon fiber drive shafts and titanium conrods.
Pretty. It's so pretty.
It's a beautiful product. I'm excited to talk to the CEO and founder of Revology. Tom Scarpello joins us at 10:30 a.m. New York time. This is Open Interest.
Now, investors have reduced their exposures to U.S. equities by a record amount in recent weeks, according to a Bank of America survey that is very closely watched. We're going to discuss where the money is going with Bloomberg's Jan Patrick Barnard. What are the ramifications here? Because sentiment has already been something people are watching very closely. People are now paying more and more attention to the flows.
Yeah, absolutely, and that's a good thing to do. And I guess, like in that survey from BOFA, what we have seen there is no big surprise that people have turned their back on the U.S. trade, which has worked so well for the last 2 years, or even for the last 10 years, if you want to argue that way, and that they have moved more into like defensive sectors. That Europe is everybody's darling. That makes kind of sense, and that basically is that what we have seen playing out in markets as well. It's also interesting that people have increased their cash position. I think it's the biggest increase that we have seen since 2020. It's still relatively low with about like 4%. But it shows you that people have become a little bit more cautious. The outlook is just like so messy and so clouded that people feel like they have to act on the side of caution for the moment. And that was reflected in trading the last 2 weeks and is now reflected in that survey.
It does seem to be, JP, really the defense stocks that are rising. I've been digging into this chart function on the Bloomberg terminal, CHRT. And it's so awesome to see all of this info charted. Like Rheinmetall shares, I didn't realize, have surged 1,300% in the past couple of years. Is this all about European defense stocks? Is this all about, Germany's rearmament?
Well, that certainly is a big part to the trade that we are seeing. Like, I mean, on the bigger picture, I would say like what has worked well for the last couple of years in stock markets in general is like you want to deploy your money where you have fiscal expansion, and that was the U.S. as the pretty much only place for some time. China from time to time here and there, and Europe was always like fiscally not really expanding, and this is now changing. A huge part of that, of course, is the defense play for good reason, and I mean like the relationship between the U.S. and the Europe are, like, I would say, beyond tense, and it makes sense that Europe is looking a little bit more after itself. I would also like say the defense trade, I mean, it's always the same with like stocks. We go over the top all the time to the upside and to the downside, and there is good argument to say like that the defense trade has run a little bit hot at this point. When you speak to people out there, they also tell you that defense manufacturing, it's a low margin business. It's high competition, except for some like areas. You need lots of cash, lots of commodity. It takes a long time to get a tank from production into the battlefield and get your bill paid. So I would say like that people like the trade for right now makes sense. It's probably going on for a little bit longer, but it's also like it's not something that is like on that degree that we have seen like going on forever.
All right, fantastic intel from the heart of the beast. Bloomberg's JP Barnard coming to us from Frankfurt. Coming up in the next hour, Goldman Sachs' David Kostin joins us, plus Revology CEO Tom Scarpello and Ireland's Deputy Prime Minister. This is Open Interest. 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is off today. And coming up, leading the pack, Goldman's David Kostin was the first major strategist to cut his S&P 500 target this month. And he's joining us to defend his call in just a few moments. And as President Trump embarks on a trade war that's roiling the global auto industry, we're going to speak with Tom Scarpello. He's a veteran executive with experience at Ford, Jaguar, and Nissan. Meanwhile, on the geopolitical front, investors are watching what emerges from President Trump's call this morning with Russian leader Vladimir Putin. A lot of cross currents to digest in this market, Matt.
Yeah, there is a lot going on geopolitically as well as inside the tech sector. Let's get a check on what's going on the major indexes. You can see the drops are accelerating. So the S&P 500 now down more than 1% to 5610. The NASDAQ down almost 2% at 19,440. The U.S. 10-year yield is little changed at 4.30, but always important to keep an eye on that yield at its new level.
There's only one index, one sector in the S&P 500 that's up right now, and it's energy. So I think that tells you a lot where sentiment is right now.
Yeah, and we've seen oil, I think it's up again today, so the third day in a row, although to a relatively low level. Let's talk about what's going on in stocks right now with the chief U.S. stock strategist over at Goldman Sachs. David Kostin joins us, I'm pleased to say, right here on Open Interest. David, thanks so much for your time. Last week, you were the first major strategist to lower your S&P 500 price target. You cut your year-end forecast to 6,200 from 6,500. Just tell me, first off, what's behind the call, and are you worried about a slowdown in earnings?
Well, the genesis for why we reduced our year-end target is really a function of greater uncertainty and a slowdown in economic activity. Those are two key inputs into our earnings model, and that's also a component of our valuation model. So the bottom line is we're looking for earnings growth in calendar 2025 of plus 7% and 7% growth in 2026. So 2 years of about 7% growth. Previously, we had anticipated around 9% growth this year, and the key driver behind that is a slower economic forecast for the U.S. economic output, and as a result, we have a lower year-end target around 6,200. So it's a similar kind of return as we anticipated before, but just from a lower level. And obviously recognize that that's a challenging situation because the tariff assumptions we're making, we're now assuming that the tariff rate is going to increase by around 10 percentage points. It's consistent with our colleagues in U.S. economics research. And so the tariff rate, Matt, in the coming year will be around 13% in our model. Previously, we had assumed around 3%. So those are really the three building blocks: the slower earnings growth, largely driven by slower economic activity and a higher tariff rate, and then a slightly lower PE multiple ascribed to the year-end growth for next year.
You know, David, the sentiment out there is brutal, and you see it in some of the big tech stocks. The Magnificent Seven today is down, getting close to 3% just today alone. You have started calling this the Maleficent Seven. Is that how you say it? Magnificent?
Maleficent, that's right, I think.
Maleficent.
The Maleficent Seven. And, you know, what can happen to turn that around, if anything? What are the broader market implications for sentiment and what has been the darling sector in the market to turn so low?
Well, I think the proper way to think about this is that the extraordinary returns for the U.S. equity market over the last 2 years has really been driven to a meaningful amount by the 7 large companies that are the sobriquet, the Magnificent Seven. Unfortunately, from a portfolio management perspective, it's been Maleficent Seven. It's been the real source of pain in the market this year. And without those companies, which are down roughly 12% year to date, the rest of the market is actually up. The 493 remaining stocks are up around 1% year to date. So it gives you some context around the importance, the influence that these companies have had on the broader market. The idea of these companies, the uncertainty around some of the regulatory environment, the source of when the hedge fund community in particular, which is largely invested, tilting their portfolios towards these companies, that's been a source of selling. On the other hand, about 60% of large cap mutual funds are actually outperforming their benchmarks because they've historically or traditionally been underweight these stocks. So it has had differing implications for different groups of the clients of Goldman Sachs. And it's an important way to think about our outlook for this year is the idea of a broadening of the market. That's been central to our forecast and outlook for investment strategy for 2025. The idea that a broadening of the market is likely to take place, and that has been consistent with what we were anticipating. The idea of keep going, Matt.
Well, I was just going to say, broadening, that sounds great, and hope you're right about it, but there's still got to be some leadership, right? And if it's not the Magnificent or Maleficent Seven, Nvidia right now leading declines as the NASDAQ 100 falls almost 2%. Who takes over? Who does the heavy lifting here in a rebound?
Well, the point you identified correctly is that about a third of the market cap of the S&P 500 are these seven companies. So clearly they have a disproportionate impact. 7 companies, more than 30% of the index. You can get a broadening of the market in other ways, which is the greater uplift in the typical stock. You can see that in healthcare companies. They've actually done pretty well. You've had some defensives generally done well. This is an area we've been focusing on with respect to discussions with fund managers of how to position their portfolios in this market. Specifically, what we're looking for is what are the 3 drivers of the market that have been afflicting the companies this year has been a question about where we are in the AI transition. And we've gone, obviously, Nvidia, a terrific story, terrific company from a stock point of view, was really an extraordinary driver of performance in the last couple of years. Obviously, that's moved a little bit in the other direction. Well, that is sort of phase 1 of what we think of as the AI transition. Phase 2, which is the infrastructure, where a lot of the hyperscalers are located in that sort of category. Utility companies, really companies that are involved in the build-out of the infrastructure for AI. And really the focus of fund managers now has shifted to the third phase, which is the applications. A lot of the software companies, stocks down dramatically last year. They've actually been an area of focus for
David,
portfolio managers. So now that's where we're focused.
One issue, I think, for portfolio managers, and what you're saying, actually, there's a silver lining in that. If you have mutual funds finally outperforming because you have a broadening of the market, that's actually great for your retirement account because of the diversification many FAs, financial advisors, have on. But a lot of the trades this year that have done well are really, really defensive. And even then, at this moment, people are having a really hard time buying the dip. So what is your advice? What are you telling clients who are looking to take advantage of the fact that the market has fallen so much when they don't know what the low is?
First of all, Sonali, we have to put this in context. In any year, the typical drawdown is 10%. In any year, you typically get a peak-to-trough drawdown at some point of 10%. Well, that's what we've got. So it's not so extraordinary, and it's largely driven by some of these biggest companies we just been speaking about. Absent that, the typical stock is down maybe 5%. So where are we focused? We're focused on a couple of things. Number one, what are some stocks that are insensitive to some of the drivers of the market, some of the idea of economic activity, the idea of it potentially slowing down, the idea of concerns about the return on capital that so much of the AI story has been based upon. Well, there are companies where their trading in the last 6 months have really been less sensitive to regulatory environment, uncertainty around the economy. Amdocs, MSCI, you can think of companies in a lot of healthcare companies there. They have traded in a pattern that has been unrelated to some of the key drawdown sources, which has been a reassessment of how fast the economy will grow, focus on the AI. So there's a bunch of companies we call our insensitive portfolio, stocks that have not displayed price sensitivity to some of these bigger themes that have been buffeting the market in the last several months. So that's a strategy to be thinking about for this environment. For those portfolio managers who are consistent with our view, which is the economy is still growing, the market is going to end the market, likely to end the market, the year higher than it is today, 6,200. There are some stocks that are really not so sensitive to what's been happening in the day-to-day news flow.
We'll look to the insensitive portfolio. In the meanwhile, when you cut your S&P target, you raised your target on Europe's stock 600, or the outlook at least there. Are you saying this is like the go-to trade? Because it certainly has been working.
It certainly has been working. And that question really relates to what's the longer-term investment strategy. And we've been focusing for a while on the U.S. exceptionalism story and the idea that U.S. companies have a dramatically higher reinvestment rate of their cash flow. To give you an example, for the last decade, on average, U.S. companies reinvest around 40% of their cash flow back into their business to grow the business, whereas the rest of the world's stock markets, it's around 25%. That's a pretty meaningful gap, and that gap can persist year after year after year. So the idea of companies, U.S. companies investing for the longer term is something that's unique characteristic of U.S. companies. That's one area why, from a longer term perspective, U.S. stocks likely to continue to do better. They've obviously been a source of awesome performance for the last 15 years. The valuation has come down slightly, but the earnings growth still in the United States of 7%, Matt, is going to be much greater than you're getting in Europe. Europe's really had a valuation recovery off of a low, but it's still, U.S. companies will have faster growth, and admittedly they trade at a higher multiple, and they're also investing more to have that growth persist.
David, we thank you so very much for joining us today. Of course, it has been a tough trade out there. That is David Kostin of Goldman Sachs, early to make that call that things this year might not be as rosy as we came in the year believing they would be. Now, we're going to switch gears. We're going to talk about the Wall Street beat, because part of the negative energy here is from momentum investing cratering. The hedge fund strategy of buying up winners and selling losers, it's been struggling bigly due to tariff-fueled volatility and big tech underperformance, and that's exacerbating moves in the market. Joining us now for more, Bloomberg's Justina Lee out with an incredible story this morning talking about just how much pain is being felt under the surface. Momentum has been such a massive trade for hedge funds. They now have to unwind. What does that mean in terms of the broader ramifications?
Yeah, that's right. I mean, obviously, we don't really know what's going on inside hedge funds. But if you look at sort of their performance and the performance of momentum, what it tells you is that, a lot of the time, they've been kind of like everyone else, kind of buying these winning stocks and maybe shorting the opposite. And that is a trade that's kind of done really well last year. Last year was historic for momentum. But finally, it's starting to crater. And I think what this really tells you is people are wondering how much further can this go. And in fact, today we are seeing kind of momentum falling further. And if you look at kind of what momentum has done in the past, it has a history of crashing. And if you kind of compare this episode to past episodes, that kind of indicates that maybe this unwind is not over yet.
What are hedge funds supposed to be doing? I mean, it seems like from reading this story and from following the industry that a lot of them are making the same moves, which is concerning because you don't want them to be correlated.
Yeah, exactly. And I think partly it's just because, it's pretty normal that if you kind of have a team that's really doing really well, you let them kind of maybe run more risk. And if a strategy hasn't been doing that well, everyone wants to cut risk. And I think, there's been a convergence into that model of operation, right? And so it could be that this volatility turns out to be a great opportunity. But then I think everyone's having trouble adjusting their strategies for this moment, especially because so much of it is related to politics, which can be pretty hard to kind of quantify and, incorporate into a lot of, teams' investing models.
Interestingly enough, there are things that are doing well, too, in this market. You have the big multi-strats down through the March volatility. I'm sure this last couple days have not felt well. Bridgewater is up. Kind of a shocking amount, more than 11%. I think that says something about where we stand, where risk parity might be something that people are looking to right now, where international diversification, a lot of investors are feeling that, riding the volatility on currencies. What's working, Justina? I mean, why would Bridgewater be doing well in this environment and other multi-strats not?
Yeah, I think macro is a really interesting space right now because, Bridgewater is doing well. But, in your story, it also mentions that a lot of the other macro funds like Brevan Howard isn't doing as well. And I think if you look at all the macro volatility, you can see how that actually could be a great opportunity. We have big divergences across, international markets, between this country's stocks and another country's stocks. And so if you think about it, a lot of these models are surfing kind of these relative value trades. So you can see how that could be a great opportunity if you happen to be riding those markets. And I think the divergence we're seeing between macro fund performance right now kind of reflects that. It's been pretty binary whether you kind of got that trade correct or not.
Justina, Thank you so much for joining us today, breaking down all the moves under the surface. That is Bloomberg's Justina Lee. And it's incredible because, Matt, there's a few things happening at the same time. You have funds diverging in performance. This leaves me with a massive question. Where is the dry powder? Even if there's a dip to buy, if everyone's suffering through losses, then are they going to be as willing to put that marginal dollar to work?
Yeah. We know that regular fund managers have more dry powder than they have in a long time, more than 4% according to the Bank of America survey. They're not putting that to work today. Nvidia, which is already down 20% from its peak, is down another 3.7%. Tesla, a big loser again today, now down almost 7%. Facebook is off more than 4%. It is absolutely brutal in tech, right? Nvidia, Tesla, Meta, Amazon, Broadcom, Microsoft, Google, Netflix, Palantir, all the biggest losers on the S&P 500 right now, and as a result, you have your NASDAQ 100 off almost 2% near its session lows, right now down 1.8%.
The fact that energy is the only sector up in the S&P 500 right now, it says so much about where we are right now, and that geopolitical uncertainty is some of what's causing that.
Yeah, coming up, we're going to talk about that. Putin wants Trump to stop sending arms to Ukraine. He may get that in negotiations. More on the ceasefire talks next. This is Open Interest.
Bloomberg has learned that Russian President Vladimir Putin is demanding the suspension of all weapons deliveries to Ukraine during any ceasefire proposed by President Trump. The two leaders are set to speak by phone sometime this morning about ending the war in Ukraine. For more, we are joined by Bloomberg's Tyler Kendall reporting from the White House. And as we know, these talks have been choppy, they have been long, they have been uncertain. What kind of certainty might Americans find today?
Yeah, well, hey, Sonali, Bloomberg News reporting that the Kremlin could be trying to slow roll the negotiations here. You mentioned there are concerns about Western security flows. There's also, they've spoken about concerns when it comes to the future of seized territory and Ukraine's neutrality. Now, going into these talks, really, the White House has remained some level of optimism, a relative optimism at least, despite Vladimir Putin not committing to that 30-day peace plan that the U.S. has backed. Now, I spoke to one foreign policy expert who told me that this is really a tightrope that Russia is walking here because the Kremlin does want to see improved relations with Washington. For example, we know that commerce ties are something that's expected to be discussed on that call today. I actually had the chance to catch up with Treasury Secretary Scott Bessent here on the White House North Lawn earlier this morning, and I asked him how the U.S. is going to use its economic might going into this call, and he said at this point everything is, quote, path dependent, after earlier this morning threatening that the U.S. is ready to ramp up sanctions if that's what it takes to get Russia to the negotiating table. Sonali, just quickly, of course, on the other side of this is that Ukraine has already agreed to that 30-day ceasefire deal. It comes as our European allies sound the alarm. This could be an unfavorable deal for Ukraine. Perhaps the biggest question going forward on that end is what those security guarantees are going to look like and whether the White House will back them.
What do we know about how much land the president is willing to give up to Russia? I mean, which territory in the Ukraine is the president going to give to Putin?
Well, that remains to be seen. President Trump did allude to that they are already starting to have discussions about dividing up the assets, as he called them, alluding to territory concessions and also critical energy infrastructure. White House Press Secretary Caroline Leavitt confirmed yesterday that one of those areas in question is perhaps one of the largest nuclear power plants in Europe that is currently in Russian-occupied territory. So we're going to wait to see what sort of concessions this White House is willing to negotiate here moving forward in order to get Russia to the negotiating table. But of course, one of those big things going forward is once those concessions are put forward, will Ukraine agree to it? And what will those security guarantees look like as our allies press this White House for more firmer guidance on that?
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall reporting from the White House, and we hope to get a readout of that call shortly after this program. Let's take a look quickly at markets here as the NASDAQ 100 falls 1 3/4%. Nvidia, of course, leading those declines. As we told you, the S&P down more than 1%, and it's Nvidia as well as the rest of the Mag 7 on the downside this morning in terms of the S&P 500. We do have Apple gaining, but only minimally. Intel up more than 2%, but obviously it's a very small stock.
Right, on any other day, you would have had, for example, excitement around things like Alphabet and Google doing a $32 billion deal. On a day like today, there's too much negative sentiment. There are too many geopolitical headlines. There's too much uncertainty throughout the entire course of the day. And
who knows if the deal gets done?
Who knows if the deal gets done? We also hear from Jensen Huang later today, so let's not forget that.
Yeah, very much looking forward to Jensen Huang and Nvidia's GTC. We'll bring you all the coverage as it unfurls. This is Open Interest. Welcome back to Bloomberg Open Interest. I'm Matt Miller. We're looking at markets that are down really across the board. Take a look at this big chiclet screen. I love it.
It's incredible.
It would be better, obviously, if these numbers were all green. But Nvidia down 3.25%. You've got Tesla down 6%. Palantir down a little over 4%, as well as Facebook. And the interesting thing to me, as you point out, is that Facebook is now down year to date.
Meta was the only holdout in the Magnificent Seven. You now have Meta down on the year as well. I look at this so closely because it's a sentiment barometer. And what else is a sentiment barometer here is if you look at the trades that are actually up on the day, these are not easy trades to make anymore. Gold has been bid up to a record. It's well over $3,000 now. Can it go much higher? Energy's been bid up, but that's uncertain because of growth concerns. The dollar has been an ugly trade throughout the entire year, yet you're seeing a bid there today. So even the safety trades don't have a lot of safety to them.
Yeah, absolutely fascinating stuff in this market sell-off. We'll see if Nvidia can put a stop to it. Coming up, we're going to give you a break from the blood and talk about Revology, making the dreams of automotive enthusiasts come true. This is Bloomberg.
The world digitizes and electrifies in vehicles, you see an increase in interest in cars that inspire some level of passion. We've talked about this kind of thing in the past, and that's resulted in people really, falling in love with the restoration of old Mustangs or old Porsches. And the reason is the experience is so analog and visceral, right? You get into a car, it feels different, it smells different, it drives different. It's likely a vehicle that you fell in love with as a kid and then ultimately lusted after as an adult. And I think that, we look at that, we see a very rosy outlook for the forward demand of these things.
So Revology is doing something many automotive enthusiasts have always dreamed of, but never had the resources to do themselves or the factory connections. They have re-engineered classic Ford Mustangs with a modern suspension and drivetrain. And today, Revology is introducing its latest car. They're putting out a 1969 Mustang Boss 429. And like the Shelby GT350 that they already make, the Boss will be built at Revology's Orlando, Florida facility using modern tech and materials like carbon fiber and titanium, much of it coming directly from Detroit. Joining us now is the CEO and founder, Tom Scarpello, who spent many years running the special vehicles team at Ford itself. And it's, Tom, a pleasure to have you on the program. Thanks so much for joining us. Tell us first about how this all started, how you came from an OEM to create something unlike anything we've really ever seen before.
Yeah. Well, first of all, thanks for having me. It's really exciting to be here. This started a long time ago. I've been a lifelong car enthusiast, and I've always loved the classic cars, but the driving experience is really a big shortcoming. We're talking about 60-year-old technology. And, if you put that in perspective, we don't have 60-year-old appliances in our homes, and we don't play golf with 60-year-old golf clubs, but, you've got a vintage car and you've got 60-year-old technology. So it really leaves something to be desired. So this idea of modernizing, re-engineering a classic vehicle with modern technology and materials, to me was really compelling, and it seemed that there were a lot of other people that felt the same way. So we were able to create a business, and we've had significant growth since we started over 10 years ago, and we're on a great path.
To be clear, and this is something a lot of people are confused about. I saw you explaining it like over and over again to Jay Leno. These are not restored cars. You don't take an old Mustang and make it better. You've re-engineered everything. I mean, like the door handles or the hood hinges, and built it yourself from the ground up in Orlando, right?
Well, we've done it both ways. We've done it as a rolling chassis replica, and we've also built cars from original Mustang donor vehicles as restored vehicles. So today, currently, this year, we're focused exclusively on building restored cars from original vehicles. But, you know, we build them all essentially new. You know, certain parts cannot be refurbished. You take steel that's rusted away, it has to be replaced with new parts. And so we do the whole thing in-house in our factory in Florida, from the assembly of the body structure, the body in white, through paint, trim, chassis, and final assembly, so we can control the overall process and ensure we have a predictable outcome.
You know, I'm really glad you brought up steel, because these days it brings up a very emotional response with what is going on with the tariff strategy in the United States as well. If you're looking for new parts and if you need steel in order to put cars together of all sorts, particularly ones that are more expensive, what does this mean to you? I mean, ultimately, how is this strategy going to impact what you do?
Yeah, well, you know, if these tariffs stick, it would be a big issue for us. You know, we have a lot of cars that we've booked well in advance. The price is fixed. So, you know, a sudden increase in the cost of our materials, we're going to have to absorb it. So that's a really big issue. The other thing is that, you know, we build in low volumes. You know, this year we plan to build not quite 90 cars. And, you know, there's not a lot of you know, companies that are that interested in low volume. So often we go overseas and we find, you know, suppliers that might be willing to do things that U.S. suppliers just, they're not oriented towards. It's not, you know, kind of doing low volumes is not their business. So it's a real, I think it'll be a real challenge for small companies like ours.
Have you been able to raise prices? Tom, what's your pricing power like in this market? You're putting out a new car, a 1969 Boss 429. It looks absolutely killer. What are you going to charge for it?
Yeah, well, we're not ready to announce pricing for the Boss yet. So our current price range goes from $283,000 for the 67 or 68 Mustang GT Fastback to $354,000 for a 68 Shelby GT500 KR convertible. You know, we'll be, I think, above that range. The Boss is bringing in some new features and technology that we haven't had before. But you know, I think it's tricky to try to push too high. You know, it's you get into this price category, and you know, you compete against a lot of other things, not just automobiles. Because it's a discretionary luxury purchase. So I think it's tricky. I think we need to hold the line on pricing as much as we can.
Can you give me,
yeah.
Tom, can you give me some of the details on the Boss? I mean, I know you have in your cars a carbon fiber drive shaft, an 8.8-inch rear end, a locking differential, sometimes a supercharged Coyote 5-liter V8. What do we know about the Boss 429?
Yeah, well, one of the things that is unique about us is that all the cars that we build are built on a common platform. So the platform is the component set that includes the powertrain, chassis, driveline, electrical system, and so forth. That allows us to deliver modern performance, reliability, and comfort. So the Boss will get this platform. Some of the unique things about the Boss, the interior is a big departure from anything we've done in the past. Almost the entire interior is composed of Revology designed parts. So it has the look, the feel of the original Boss, but it's a much higher level of craftsmanship, the quality of the materials and so forth, and the ergonomics are much improved. So a really nice driving experience, because really that's what our cars are about. You know, they're not, they could go in a museum or they could go to a high-end car show and win trophies, but they're really about driving, so they need to be comfortable and enjoyable to drive.
Tom, we thank you so much for your time today. I do indeed think your cars are beautiful. That is Tom Scarpello of Revology. Gotta love a good muscle car.
I think, you know, it's awesome because the machinery, like the experience that they engineer is one thing, but it's also a sculpture, it's rolling art, and it's an investment as well. As Tom Wagner said, it's a dead man's car. You know, you buy it from the estate of a guy who died, and then hopefully you keep it until you die yourself.
You know, I'm going to blow your mind again. I spent every year growing up going to the car show with my mother. So I can appreciate a good muscle car. I actually want to show you something that's interesting today, too. Ford, GM, it's all up today on a down day. I think
that's fascinating.
Really interesting here because you do have that tariff concern. The automakers have been hard hit. They're actually getting a little relief in this market.
All right, speaking of, we're going to talk more about tariffs when we come back. The U.S. is just 2 weeks away from reciprocal tariffs. We'll speak with the Deputy Prime Minister of Ireland, Simon Harris, about how his nation is preparing next. This is Open Interest. Irish Americans across the country celebrated St. Patrick's Day yesterday. Ireland's Prime Minister Micheál Martin visited the White House as part of those celebrations last week, only for his American counterpart Donald Trump to inject a touch of trade tension into the meeting. Well, that would have been expected. The president assailed the massive deficit with Ireland, paying particular attention to American pharma companies. Joining us now to discuss that imbalance is Ireland's Deputy Prime Minister Simon Harris. Mr. Minister, great to have you here. Thank you so much.
Thank you very much
for joining us. Let me ask first about your take on trade. Ireland has traditionally had maybe a slightly different take than the rest of the bloc, but I know you want to stand shoulder to shoulder with your counterparts.
Yeah, well, look, firstly, can I say I've been here in New York for the last few days. I was in Philadelphia before, and what I'm very clear in my mind is the two-way enduring economic relationship between our two great countries now is so strong. If we look here in the state of New York, there's about 15,000 people who get out of bed in New York this morning and go to work in Irish-owned companies, about 12,500 in the state of Pennsylvania. So over 200,000 people across the United States now working in Irish-owned companies, and over 770 Irish companies doing business here with operations here in the US. And we want to grow that. And that's the message we've been taking from the Oval Office to every part of this great country. And yes, there's going to be discussions about trade. Every administration has a right, of course, to look at trade. I fully get that. But I would respectfully make the point that tariffs are bad for consumers on both sides of the Atlantic. And what we want to do in Ireland and what we want to do in Europe is engage intensively and try and find an agreement that's good for the US and good for the EU.
That's exactly where I wanted to go next. Where do you think that the EU should go in terms of their retaliatory approach to these tariffs? To your point, a lot of Irish companies doing business in the US, the other way around as well. A lot of American companies doing business in Ireland.
Absolutely.
So what do you want the bloc to be doing? Do you think they should hold the line?
Well, I think you're right. I want to acknowledge that US investment in Ireland that matters so much to us and that we've benefited so much from as well. But from a European perspective, and it's important your viewers know this, we don't want to be in a tariff tit-for-tat situation. We want engagement. And I was talking to the EU Trade Commissioner, Maros Sefcovic, very recently. He was here in DC meeting his counterparts not that long ago. We want to have a situation where instead of elongating the moment of disagreement, why not actually let's get in a room here, the US and the European Union, and actually hammer out progress. Because yes, Europe will have to respond. Of course we will have to respond, but that's not where we want to be. And we know that if we can we know that tariffs are not good for either economy. So we want to try and make progress on this. And, you know, I think talk before tariffs would be a sensible way to proceed. So we're preparing. We're preparing at an Irish level. We're preparing at a European level. Our Irish economy is in good stead. It's in a good place. Full employment, good economic growth, nearly 5% in our domestic economy last year. We prepare for all eventualities. But the point is, every disagreement has to end with agreement. And the EU is ready to talk to the United States and wants to try and make progress on this. I think we should do that rather than having a kind of further announcements and then trying to respond to it.
So why this tit-for-tat retaliation? Why doesn't the EU say, okay, how about no more tariffs?
Well, the European Union's perspective, and Ireland as a member state of the European Union, is not to want to see an environment of high tariffs. We passionately
They could make that offer. They could say, listen, how about we'll have no tariffs on U.S. goods and you have no tariffs on our goods?
We're very willing to sit down with the United States and come up with an agreement, a deal that is good for Europe and good for the U.S. I say this very respectfully. At the moment, that's not my sense of where the administration in the United States wants to go. The president has made it clear he wants to make a series of announcements at the start of April. We'd rather use the period between now and the start of April to try and find a way forward, because there's people right across this great country, there's people right across Ireland and the European Union who will feel the impact of tariffs in higher prices. prices. And I don't think that's good for consumers. I don't think it's good for economic growth. We have such an enduring €1.4 trillion worth of an economic trade relationship between the EU and the US.
So in Ireland in particular, you had last week President Trump announcing a 200% tariff on a number of alcoholic products from France and other EU countries. What kind of ripple effect does that have on Irish whiskey? This is another product that I'm sure a lot of our viewers are very used to consuming. So do you think that this is going to have a ripple effect?
Don't forget the beer.
Don't forget the beer.
Well, look,
prefer whiskey. You know?
I'm conscious that President Trump indicated this as opposed to this being something that has been implemented. And I do always think it's important that we wait and see the detail. We don't want to be in this space. We want to try and find a way forward because we've had a proud tradition of exchanging alcoholic products right across the Atlantic Ocean, and we don't want to do anything that damages that important industry in America, an important industry in Ireland, and indeed an important industry, drinks industry, right across the European Union. We have to get to a point, though, where we're not talking about trade and in simply reducing it to a conversation about deficits. I mean, Adam Smith talked about this nearly 250 years ago. Balanced trade does not actually equate to an understanding as to the advantages or disadvantages of trade. The relationship is much more interdependent. And my message in the US this week and these last few days is the relationship between Ireland and the US is long, enduring, growing, mutually beneficial. Yeah. And Ireland, as members of the European Union, wants to value free trade, wants to come up with a way forward here to work with the administration.
We're seeing headlines come across from Ursula von der Leyen. Europe needs strong defense posture by 2030, and you are not only the Deputy Prime Minister and Minister for Foreign Affairs and Trade, but also the Minister for Defense. Ireland has been a neutral country. It has the lowest defense spending in the EU. Is now the time for a shift in Ireland's defense policy?
So Ireland will remain militarily neutral, but let your viewers be in no doubt that doesn't mean we're politically neutral. We have been strong supporters of Ukraine, for example, in very practical ways, providing significant assistance for non-lethal military equipment. So we're not politically neutral, but we are militarily neutral in terms of not joining military alliances. However, we absolutely now intend to invest more in our defense and in our security. I think all countries in Europe need to do that. We all need to step up. Our immediate focus will be on our capabilities around radar, around sonar, and investing further in our personnel. You can be militarily neutral and still invest more in defense and security, and even a militarily neutral country isn't immune from some of the modern threats that we face in the world.
All right. Thank you so much for joining us, Mr. Minister. Simon Harris there, so Deputy Prime Minister of Ireland, joining us. This is Open Interest.
And it's time for our Wall Street Week conversation. Breaking news this morning, Santander's digital bank partner, Openbank, is partnering up with Verizon in the United States. David Weston sat down with Santander Chairman Anna Botin to discuss how Openbank will grow and bring a new financial product to Verizon users.
The partnership with Verizon is a major step forward for Santander in the U.S. It showcases the strength of our Openbank model. It basically allows us to reach consumers nationwide across the United States, and it will bring a very competitive and new financial product to Verizon customers. And for Santander, it's one of our strategic aims is to grow Openbank across the U.S.
Openbank has been around for a while now. How does it fit into Santander's long-term strategy?
So in an age of AI and disruption, and what we're seeing is change at a scale not seen since the Industrial Revolution, we need to go back to basics. And one of them is that consumers want fast and easy experience. They want competitive rates, great value, but they also want trust. And this hasn't changed in Santander, opened for business 168 years ago. But consumers want to engage with us in a different way. So how and where they engage is very different and is driven by technology. And so what we decided a few years ago when we started on this 10-year journey was to build a digital bank with branches. And this is what we did with Openbank. We built a prototype. And our definition of what we are trying to bring to consumers is the best digital product, the best price, with a human touch. That's why we call it digital bank with branches. And the track record shows that this is working.
When it comes to retail banking in the United States, what will the Verizon deal mean for your competitive position vis-a-vis other U.S. banks?
So the great news about this alliance, it showcases the strength of the Openbank model. Importantly for us, we're an at-scale auto lender. We've been financing millions of Americans to get to work every day, and it would allow us to accelerate that growth by diversifying our funding source and really reaching all Americans. So it's a key strategic goal for us to grow Openbank, and this funding, which is more diversified and cheaper, will allow us to grow faster.
I'm also curious about what it does with respect to Mexico. You have a large presence in Mexico. Can you connect up what you're doing with Openbank in the United States with Mexico?
Yeah, absolutely. We launched Openbank Mexico about a month ago. I was there. So the goal is the high yield savings, which we believe is the best of its kind in America. It offers 4.4%, but with the trust of a bank that has the trust of 173 million customers. But what's important is that it will allow us to connect Americans and Mexicans real time. So we will be launching new products as the year goes by, and one of them will be payments cross-border with a presence on both sides, and that's unique.
And that was Santander's Ana Botin. David Weston now joins us here on set. And one of the things that a lot of people don't realize about Santander is actually one of the largest lenders in the United States as well in areas like auto, consumer loans. They're expanding very quickly here. What did she say to you, in addition to the partnership announcement, about the relationship she has between the U.S. and Europe and her moves around all of the uncertainty?
Of course, there's a lot of questions about U.S. versus Europe, given what's going on right now in Germany, actually, appropriating more funds for defense. But she said they are really reinforcing their commitment to the United States. You heard her say that they're at scale on autos. They have, as you said, Sonali, a very substantial presence in the United States online. And they are at scale, and they are really doubling down in the United States.
So are they going to continue in that vein under the Trump administration? I mean, do they want to continue to invest in the U.S.?
Well, that was one of my questions to her. A different way to put it is, are you going to reallocate capital between the United States and Europe? You have been allocating capital to the United States, not away from Europe, but not as much in Europe. And she said, no, they're going to continue the way they're going. They have a substantial presence, obviously, in Europe, as well as in Brazil and Mexico. But she says that they are not going to change their capital allocation, even with what's going on under the Trump administration.
Did she have any concerns about where we stand right now? I mean, one major thesis here of what's going on in the markets is the concern around the U.S. consumer and global consumers.
Yeah, I mean, anybody who's watching what's going on right now in the markets has some concerns. Anyone who doesn't have any concerns isn't paying attention. But she says basically her job is to make sure that she is on it for the long term, and she believes in the long term the U.S. is still going to remain very robust despite all the uncertainty we have right now. And of course, she wants to stay away from the politics as much as she can. Although you remember she challenged President Trump at Davos. Remember that? She said, what about this deregulation? When are you getting to that? She's really keen on deregulation.
Yeah. It's just incredible.
Yeah.
Yeah, fantastic figure. Really looking forward to the interview. The full interview will come out, of course, on Wall Street Week. You can catch that every Friday at 6 p.m. with our very own David Weston. It will be fascinating to see what else Ana Botin has to say. Really I don't know if legend is the right word, but she is a stalwart figure, an iconic figure in the industry of banking. Quick look at what's going on in markets right now. You can see the NASDAQ 100 right there, down 1.7%. The S&P down 1% as well. Nvidia is not helping. In fact, leading the way down on the S&P 500 index, now down 3%. Google down 3.7%. This is Open Interest.